Good morning. I hope you're all very well. Can you believe it is May already? So the big question is, should we sell in May and go away? Be nice. Go somewhere, line a beach for 6 months and come back and St. Leger's Day and start looking at markets again. Well, we'll hopefully have more insight into that question later on. Today, in addition to the usual market update, we have a poll. I'm looking forward to hearing your views. And our head of manager research will share her latest industry update, which is going to be very exciting. Phumi, thank you for joining us today. Look forward to your section. But let's start with the markets. So looking at April was pretty much risk off. So you can see their world markets in Rand terms down nearly 5%, Japan down 9%, US equities down 5%. Risk aversion certainly rose in April, and it was driven by geopolitics, which I'll talk to you about in quite some detail, and hotter than expected inflation in the US, which I'll also talk to you in some detail about. But those two combined, worries about inflation in the US and geopolitical risks certainly led to downturns in markets. Despite that, though, quite surprisingly, we had a synchronized rebound in global manufacturing, which led to a 14% rally in industrial metals. Copper has reached a 2-year high. And that stabilization was driven by China this time, not by the US. So even though the US has started that rebound, China's taken over. And as a result, you can see that China doing very nicely in the month of April, up nearly 5% in Rand terms. And South African assets, South African equities up 3%, South African bonds up 1.5%, also doing very nicely. So quite a strange world that we're living in, with the US slowing, risks rising, and yet this synchronized global manufacturing rebound pushing up commodities and leading to some emerging market assets doing quite well while the rest of the world cools and starts to panic. And it's this dichotomy that is certainly very interesting and very hard to manage right now, but I'll definitely be talking to you about that as well as we go through each of the regions today. So how did this impact our funds? The funds for the month of April performed very similarly to the asset classes. You can see there the Sygnia New China Sectors ETF up 4% for the month. Top 40, Sygnia Top 40 Fund up 2.5% for the month of April. So SA equities and Chinese equities, both the top performers for a second month in a row, as I said, driven by commodities. And it was certainly helped by BHP Billiton's offer or bid for Anglo American. That's got the commodity sector and resource sector quite topical, and very interesting to see Anglo's rejecting that offer, and now Glencore possibly going to get involved as well. So we'll be watching that very, very closely. But if you look into that offer, BHP is only interested in Anglo's. If you look into that offer, BHP is only interested in Anglo's copper assets. They want Anglo's to divest from their platinum assets and their iron ore assets. That'll be Anglo Plats and Kumba. And that just shows the huge drive right now for the green metal copper. You know, copper is seen to be the biggest beneficiary of renewables and transition metals, and BHP and possibly Glencore now trying to get a hold of Anglo American's copper assets. So that's kept resources quite topical and certainly quite well bid for the month, and that's helped China and helped SA equities. Of course, China imports more than half of the top 6 commodities in the world, so industrial commodities at least, so very, very, very important for China in terms of those prices and those volumes. But also over a 1-month basis, you can see that 2 of our Zen funds doing quite nicely. Sygnia Enhanced All Bond Fund up 1.8%. Sygnia Income Maximizer Fund up 1.3%. So that's great to see our Zen funds doing well when globally things are looking a little bit perturbed. Over the 12-month space, very much as we've seen, driven by the FANG funds, which have FANG fund up 54.5%, a great return. Sygnia Atrix S&P 500 up next 26.6%. Similarly, the Sygnia Atrix MSCI US ETF, so those funds are both US specific, broad-based US specific ETFs, quite similar to each other. As you can see there from the returns, very close returns. Then the Sygnia Life Berkshire Hathaway portfolio up 23.9%. Now, I'm sure some of you will have seen on Instagram and Facebook that 2 of our portfolio managers, Stephen and Vessel, were attended the Berkshire Hathaway AGM over this past weekend, which was awesome to have them there and to tell us real time what was going on and share some of the insights. As you would have seen, that Berkshire Hathaway's cash pile has continued to grow. It's at $189 billion. And Warren Buffett predicts it's going to top $200 billion soon. They cut Apple quite a lot, even though they gave some very good reports about Apple. They did cut the Apple position by 13%, which also helped their cash pile grow. But generally, the broader takeaway is if Warren Buffett can't find anything to invest in, and if that cash pile is growing, does that mean markets are looking a bit frothy? And that certainly may be the case in the US. So we'll be watching quite closely to see what the guru of Omaha does going forward. But great to have Stephen and Bessel there sharing their views and real time at the AGM. And then in fifth place, the Sygnia S&P Global 1200 ETF. So we have two broad-based world or global ETFs. So that if you want to get the most diversified exposure to the world, that's either the MSCI World Index or the S&P Global 1200 Index. They're both very similar and just two different offerings, one from MSCI, one from S&P, to track global assets in a diversified way. Both up quite similarly, that you can only see the one, sorry. The Sygnia World is slightly below that, but both up about 22% over the last 12 months. But again, driven by the US. So 70% roughly of those globally diversified world ETFs and indices are US based. So that's it for our funds. 12 months, very much in line with what we've seen over the last few months, driven by US exceptionalism, driven by the FANG stocks, just driven by a very, very resilient US consumer and US spending. Whether that's about to change, that is the big question. I'll get to that on the US section. But first, look at our chart of the month. And here it's all about geopolitics and the rise of geopolitics. Certainly one of the reasons that, apologies, before I get into this chart. Okay, I said we'd do a poll this month. So we have a couple of questions. If you can go through the poll during the presentation, and I'll be reading the results out after Pumi's manager research section, just before Q&A. Right at the end, I'll take you through the results. Okay, so having a look at some of the questions. Firstly, what percentage of votes will the ANC win? About 48%, 44 to 48, 40 to 44, and below 40. Who will be the ANC's main coalition partner? So this is all ahead of our elections, the 29th of May. That's very, very topical and very, very interesting. Question 3, is China investable in the short term, short and long term, or not at all? Love to hear your views on that. Then geopolitics, which I'll talk to now. What is the probability that either the Iran, Israel, Gaza conflict or Russia-Ukraine tensions will drive oil prices over $100 a barrel this year? And that will certainly have a huge impact on inflation and global growth. And then finally, what drives the world is US rates and the dollar. So how many 0.25% rate cuts do we expect from the Fed this year? So 5 questions. Please, will you, no rush, but over the next half an hour, just fill those in and I'll share the answers with you at the end. Okay, back to chart of the month and geopolitics. Sure. Here we have some quite extreme statements made by some important people in the world. UK Prime Minister Rishi Sunak says that he is considering putting the UK's defense industry on a war footing. Meanwhile, Polish Prime Minister Donald Tusk is warning that Europe is living in a pre-war situation. French President Emmanuel Macron says that Europe faces an existential threat. I mean, those are some quite extreme statements about geopolitics facing Europe over the next 6 months. Meanwhile, we've seen after much deliberating and back and forth, the US Senate finally approved a $95 billion aid bill to deliver aid to the Ukraine, to Israel, and what they call the Indo-Pacific region, which basically is Taiwan, to try and support Taiwan against China. What's very interesting, though, is if you look into that $95 billion aid package, 90% of that stays in the US. So part of US exceptionalism is the US benefits from everything they do. They definitely are not fools. And so that's, again, another example of fiscal stimulus in the US, which will keep the US exceptionalism well bid. But looking into the actual geopolitics for the month of April, it was very much about the escalation of tensions in the Middle East. The 1st of April, we saw Israel's attack on the Iranian embassy in Syria, which killed 2 senior generals. Then on the 13th of April, Iran retaliated, which was the first attack by Iran onto Israel in history, with over 300 rockets and drones. But fortunately, not too much impact. Most of those were knocked out of the sky before they could land. And then on the 19th of April, Israel retaliated, again with limited impact. And it almost seemed a symbolic gesture. And that has certainly got the world a little bit more at ease. We've seen that oil prices are now down to $83 a barrel. They spiked to over 90, nearly $95 a barrel, now back down to $83 a barrel. So world, in terms of dollar oil prices, are showing that the world seems to believe that we're through the worst. But it doesn't mean that we are, and I think the risks have definitely risen in that region. So we've raised the probability of a geopolitical risk event in our forecast models, and we are investing accordingly. But it is just a risk event. It's still not our base case. We don't think that there's going to be a huge disruption to oil supplies. But I look forward to hearing what you put into the polls. But our base case is that oil does not rise above $100 a barrel this year. Definitely, there are risks. 20% of petroleum liquids flow through the Straits of Hormuz, and any disruption could be severe. On the other hand, if you look at the chart on the right, that shows OPEC's spare crude oil capacity, and that's risen to nearly 5% of global oil consumption, which is significant relative to its history, as you can see on that chart. And that oil supply can be brought online within 30 days, and it would certainly help reduce any supply disruptions, any significant supply disruptions that happen. So to some extent, if there are small disruptions, OPEC can definitely help bring supply online. But I think what's more important, even though risks have risen, and even though Israel is, as we speak, moving people out of the city of Rafah, and that could lead to more tensions, we are in an election year. Now, firstly, that means a lot of saber rattling. Everyone's going to be talking, everyone's going to be making threats, everyone's going to be trying to win votes by playing tough. But at the same time, every incumbent president, prime minister knows that they are unlikely to keep their jobs if the economy tanks. So it's in their interest to make sure that there's no disruption to the economy. And Biden certainly does not want high oil prices ahead of elections. So quite amazingly, he actually admonished the Ukraine for striking Russian oil refineries. And Ukraine knocked out 7% of Russian oil refineries, which pushed up the oil price last month. So he admonished Ukraine to listen, don't do that, guys. We need oil from Russia, even though there's sanctions. And he's also turning a blind eye to Iran's illicit oil exports. So even though there's a lot of talk about sanctions against Iran, he's turning a blind eye to those illicit oil exports. Iran's oil exports are now at a 6-year high, nearly all of it exclusively sold to China. Russia, the same. Russia contributes 20% of China's oil imports, and Russia contributes 12% of India's oil imports. So oil is still flowing freely from Iran, from Russia, despite the sanctions. And that's allowed the oil price to stay low. That's allowed inflation to stay low. And that's allowed the world economy to continue to tick over. So while we've raised the probability of a geopolitical risk, and while we expect saber rattling, and while we expect a lot of volatility, we don't think anyone's going to do anything foolish enough to try and derail the world economy, not with some major elections ahead of us this year. So risks have risen, but our base case remains no huge disruption. And any small disruptions that happen, OPEC can come to the rescue. So looking towards the US, which, as I said, is the major driver of global markets. The US makes up 70% of global equity indices, The US makes up, the dollar makes up 80% of global trade, or nearly 90% of emerging markets trade. So the US is very, very important for the rest of the world, and in particular, US interest rates and the strength of the dollar. So one of the reasons that markets fell off in the month of April was hotter than expected inflation in the US. For the third time in a row, the US CPI was slightly ahead of expectations. And that, with strong retail sales, convinced the world that the US economy is resilient, and that we're heading towards a second round of inflation. And markets have moved to price in two cuts, only two 25 basis points interest cuts for the rest of the year. Remember, in December, which was only 5 months ago, the market was pricing in 7 cuts. Now we're down to 2 cuts. And at the same time, it has not just markets that are pricing in fewer cuts. We had, shortly after the hot CPI number, Fed Chair Jeremy Powell signaled that the Fed can keep rates steady for as long as needed. Basically saying we don't need to cut anytime soon. There's no rush. We'll keep rates higher for longer, which has been our thesis that we've spoken about, until we can see a clear path and clear reason to cut rates. And as a result, the dollar strengthened, bonds weakened, bond yields went up, bond prices went down, US inflation break-even curves adjusted dramatically. And as I said, we've gone from pricing in 7 cuts to pricing in only 2 cuts. And in fact, at one point, the market was only pricing in 1 cut for the rest of the year, and they were even pricing in a small probability of a rate hike next year. That has subsequently changed, and now we've gone from pricing in a small probability of a hike next year back to 2 cuts. Why? Well, because we had the FOMC on the 1st of May, and Powell stated, and it was a very, very important statement, as inflation has come down now to below 3% on a 12-month basis, we're now focusing on the other goal. Remember, the Fed has a dual statement a dual mandate of employment and inflation. So he says, we're now focusing on the other goal. The employment goal now comes back into focus. He's basically saying he's done his job with inflation. Yes, it's not a target of 2%. Core PCE, which is their big numbers at 2.8%. And so it's still above, but he says it's below 3. Now we're focusing on employment, the other mandates that the Fed has. And there, things are actually starting to look a little bit worrying. Employment is definitely cooling. So we had a number of data points that came out last week. The most important was non-farm payrolls, or US jobs, which posted the smallest gain in 6 months. And the unemployment rate rose to 3.9%. So if you look at the chart on the right there, unemployment is in green. On this chart, which goes back 25 years, it doesn't look that significant, but it's definitely the highest level it's been in the last 5 years, which is a concern. Number of permanent job losses, which is a good leading indicator, also ticking up quite significantly, and that tends to lead unemployment. And that was the reason why people were worried about recession in December last year. The reason there were 7 cuts being priced in, the reason that everyone was forecasting a US recession was that unemployment would rise. But it didn't. The US consumer was resilient. The US consumer kept spending. Jobs were resilient. But now we're starting to see things start to cool. But that in itself is not too much of a concern. If you look at that chart, you'll say, well, it's ticked up, but it's definitely not a concern. It's just getting back to pre-COVID levels, and it's nothing to worry about. True. However, the forward-looking indicators are something to worry about. And I think that is what the Fed chair is concerned about. The employment components of both the ISM manufacturing and ISM services surveys remain below 50. And the latest reading was the lowest level since May 2020. It reached a print of 45.9, a very, very, very low number. That is the issue. Not only that, but US job openings are now at a 3-year low. That's what jolts. Quit rates are at a 4-year low. So you may start to think, well, employment is falling, which means growth is falling. Inflation hasn't started to roll over. It's still above 3%. Is this not stagflation? Well, if it walks like inflation and smells like inflation, stagflation, maybe it is stagflation. But we had to, well, Jeremy Powell was very, very clear to try and alleviate those market concerns. And he said at the FOMC, he said, This is neither this is neither stag nor inflation. He said it's not stagflation, it's not stagflation. Growth is not slowing and inflation is not rising. And he's trying his best to convince markets otherwise. And I do think he's right. Generally, employment leads wages. Wages lead inflation. So employment falls, people have less ability to get wage increases, and inflation, then wage inflation falls, and it leads inflation to fall. So it does take some time, but what we're looking at, these employment leading indicators for employment tends to be leading indicators for inflation. Now, inflation might still take a while to slow, but the Fed is quite confident that this is neither stag nor inflation, and that employment is softening. But what that means, bottom line, then, is that if the Fed sees unexpected weakness, they will ease, even if inflation is above 2% target. So it sounds like, well, the Fed's in a tight spot, right? Inflation's not back at 2%. So if they don't cut, we could have employment falling and recession starting. But if they do cut, inflation could stay above 3%, and then you've got an inflation problem. So it is a very difficult place to be in, even if the Fed's trying to talk it down. But I think the likelihood, if you with given these forward-looking indicators, the Fed is actually right, and I think that inflation will cool with employment. But right now, that's still not the case. For now, the US remains exceptional and growth remains strong, and the US consumer continues to spend. Retail sales are stronger. And in particular, in light of geopolitical risk, we remain overweight the US. And the question that has been raised is, why is the US so exceptional? Why over the last 18 months has it been so strong? Why has the US consumer been so strong and the rest of the world is so weak? Part of that is household net worth. So household net worth has risen dramatically and hasn't rolled over. That's driven up the wealth effect. When people are feeling wealthy, when they've got equity in their house prices, they bought their house for 100 Rand, the house is now worth 120 Rand, they don't mind spending that extra 20 Rand, even if they have no savings, even if they have to use their credit card, because they feel like they've got that money, it's just not that liquid. So, or if they've got it in their retirement funds have gone up 50% because Americans are more geared to FANG stocks than the rest of the world. So they're feeling that appreciation of NVIDIA more than anybody else. And that has allowed them to carry on spending. And that's not going to change anytime soon. So that's one of the reasons that US will stay exceptional for a little bit longer than is expected. But at the same time, part of the exceptionalism, part of US resilience has been fiscal policy. And we've had quite an unprecedented statement. The IMF came out and criticized the US, saying the country's recent strong performance was partly driven by unsustainable fiscal policy, basically saying the US is taking on too much debt, and they're using that debt to keep growth strong, and it's not sustainable. And of all people, who I didn't know he was an economist, but he is a genius. So maybe he knows everything. But Elon Musk is now warning about dollar weakness because the US has had debt levels are too high. So it's not just the IMF. Elon Musk is also worried about unsustainable fiscal policy and too much debt in the US. And that was spent on the COVID stimulus, but money was spent on the Inflation Reduction Act, was spent on the CHIPS Act. And now, as I said, it's been spent on that $95 billion aid package, which is mostly staying, 90% of which is staying in the US. So again, it's more money just being thrown at US industry, US manufacturing, US consumers to keep the US going. So it's a little bit too soon to write the US off, but the employment is definitely cooling, and we're watching this very closely because we need to make sure that at some point we either need to switch out to the US into the rest of the world from our positioning, or switch out of US equities into US bonds if we think that inflation is starting to cool. Right now, though, things aren't there. And part of the reason things aren't there is the rest of the world is growing quite nicely. And here we have ECB President Christine Lagarde, and she said that output is recovering, and we are clearly seeing signs of recovery. And it's very nice to see some signs of recovery. Europe has basically been like Japan and like the UK and like China and like most emerging markets, it has been stagnating for the last 18 months. And finally, we're seeing some signs of recovery. So over the last 2 years, global manufacturing has been held back by high interest rates, no surprises, a strong dollar, because people have to, rest of the world borrows in dollars to finance commodities, which they use as raw materials, which is an input to manufacturing, makes it more expensive. It's been held back by the Chinese housing bust. It's been held back by the EU energy crunch and COVID distortions. And right now, we're seeing a synchronized global manufacturing recovery, which is definitely unusual. As I said, it's quite unusual to have a synchronized global manufacturing recovery when interest rates are as high as they are, because it's expensive to start investing in manufacturing plants. It's expensive to start borrowing money when US short rates are above 5%. So why are we seeing this synchronized global manufacturing recovery? Well, one, US consumer is still resilient. Two, China has been doing piecemeal stimulus, particularly with a focus on manufacturing. Three, COVID is still distorting markets. We went from everyone was in lockdown, they could only spend on products, to everyone, lockdown ended and everyone went traveling and didn't spend anything on products. And now that loop is finally starting to phase out and people are spending on products again, which is driving manufacturing. But one of the biggest drivers is investment in manufacturing facilities. And that's being driven by onshoring and friendshoring. Basically, China is trying to build plants everywhere around the world so they can still access global markets just via Mexico or via Africa or via Eastern Europe or whatever it may be. They are building plants, manufacturing plants, so that they can still access those markets. And that's, that leads to a huge drive in manufacturing, a huge drive for commodities, and we've seen that feed through into markets. And the chart on the right shows that quite nicely. So all markets that are geared to that global manufacturing recovery, Japan, Europe, emerging markets are all looking good. So the ZOO index, which is forward-looking expectations for Europe, that's at a 26-month high, which is fantastic. We're also seeing small open economies like Taiwan and Korea, also seeing their export orders, which lead growth, also as jumping up very nicely. So all of that points to a rebound in the rest of the world growth. Now, the big question is that sustainable? Because interest rates are still high. Will high interest rates lead to this recovery starting to cool off? Or will a US slowdown lead to the starting to cool off? And we've just seen US numbers, the US PMI numbers are back in contraction. So to what extent was the US resilience driving this and now the US is in contraction? Or is it China? Is China driving this and China is quite resilient? Or will China slow down because of tariffs? And I'll talk more about that on the next slide. So there's a lot of uncertainty about how resilient these green shoots will be. And as I said, it is very unusual to have these green shoots repeat when interest rates are so high. So if interest rates stay high, if China manufacturing is to taper off because of tariffs, if the US goes back into manufacturing, goes back into contraction, if COVID is already in the base, all of these things could lead to this tapering off quite soon. So from our perspective, we remain over at the US, and we haven't moved into the globally sensitive countries like Japan and Europe and emerging markets. But again, we are watching this very closely to see what happens. So part of the reason that the global manufacturing rebound was so strong was driven by Chinese manufacturing, and particularly Chinese focus on manufacturing. President Xi Jinping's vision to power China's economy through a major manufacturing drive is definitely showing results. China has poured money into manufacturing, focused on the three new, I can't pronounce the Chinese version of that, so I'm just going to call it the English, the three new economy that includes digitalization, AI, and the green economy. And those all kind of, to me, sound like the same thing. New sector economies, which is what our Chinese ETF, the Sygnia Chinese ETF, focuses on, the new sector economies. But definitely that is a strong focus. And that's led to a very, very strong rebound in Chinese manufacturing. So particularly products like new energy vehicles, solar cells, and lithium-ion batteries were a key export driver in 2023. And they all grew above 30% last year and make up now close to 18% of GDP. So this manufacturing rebound is growing in its contribution to Chinese GDP. We've got a chart on the right, so you can see the exports ticking up nicely, but the solid blue line, real estate investment plunging. And property is now down to only 8% of Chinese GDP and continuing to fall. So it's not quite yet there. The property is definitely still an overwhelming drag on Chinese GDP, but we're definitely seeing manufacturing trying to counter that, and the Chinese consumer definitely helping counter that. And all of that led to China's 2024 Q1 GDP exceeding expectations, up 5.3%. But the big question is, to what extent does this continue? Chinese exports were up massively. Chinese exports what drove that huge GDP surge in Q1, and part of that was Chinese vehicle exports. China last year became the world's largest car exporter, overtaking Japan. So there's now a huge backlash about China's dumping. And we had US President Joe Biden blasting Beijing as xenophobic and vowed triple tariffs on Chinese steel and aluminium exports, while trying to get Congress to ban TikTok from the US. So that's, I would say that's probably more xenophobic than China is, but or at least as xenophobic. So it's interesting to see that. But when you look at what's actually happening, that's not the case. You certainly can't make a strong case for China dumping vehicles in Europe. In fact, Chinese vehicles in Europe are twice as expensive as they are domestically. So there may be a slowdown in Chinese exports if tariffs kick in. Other exports like solar panels, there's more of a case for tariffs, and EV batteries, more of a case for tariffs, but certainly not for manufactured products like cars. So once again, we're going to be watching China quite closely. Will the property market pull down growth in the second quarter, or will tariffs reduce exports, Chinese exports, particularly in those three new sectors and those three new products? Or will US slowdown lead to a slowdown in exports? We're watching that quite closely, but for now, we're not convinced that this is a sustainable rebound, and hence we haven't taken any direct exposure to China. Moving on to South Africa, always colorful. So here we have a quote from a BBC article. South Africa election, Jacob Zuma and MK party lead 3-0 in court battles. And certainly Zuma is the wild card in the elections on the 29th of May. Zuma has thwarted attempts to stop him or his new party from contesting the general election 3 times. His latest victory came against the ANC, who tried to force his party to drop its name and logo, but they lost that court action. And it's definitely impacted the polls quite significantly. So the chart to the right there just shows the average polls over the last 6 months, and you can see the ANC getting only about 41% of the votes, 39% of the median, which is down a massive 20% from the 29 elections. I mean, that is huge. That's a third less since the 2019 elections. But it's on trend for the municipal elections, so maybe it's not that hard to believe. If you look at the highest number, it's the Institute of Race Relations survey, which came out, it's still quite old, unfortunately, that came out before MK party, 46.5% of the votes. So it's not that reliable. But I think I'm definitely leaning towards Standard Bank economist Simon Fremantle's base case scenario, which is a 60% probability. He has the ANC with 45% of the votes, partnering with the IFP, DA at 20%, EFF at 12%, MK at 6%, and IFP at 5%. Now, why so much higher than the polls? I think that all these polls were done before electioneering really kicked in. And we've seen the ANC certainly make a lot of promises in the last month. Promises are cheap. Anyone can make promises. And they don't even have to be realistic. But there are a lot of promises that are going around, a lot of electioneering activities. And I think that is what's going to bump up the ANC from the polls of 40% to closer to what Standard Bank's Simon Fremantle think of 45%. They estimate that if the ANC does partner, if they get 45% and they partner with the IFP to give them that 50% the majority, that'll take a lot of negativity out of the rand, and the rand could strengthen to 18 to the dollar, and bond yields could rally as much as 0.75% in terms of yields. Yields could fall that much. So that's definitely something that we are looking at. There are also some reasons to be positive. South Africa, it's the rand. We've seen some corporate action about Anglos with the bid from BHP. There's also a bid from Canal on MultiChoice, DStv. We've also seen there's some buyout rumors of Barlow World that could be local, but most likely global. So that could all lead to stronger rand. We're also seeing the fact that if once we get past the elections, so we need to wait until 20th of May, but once we pass that, I think the foreigners are certainly, they've been sitting on their hands, sitting on the sidelines, and once that risk is passed, because there's definitely a risk that the ANC gets around 40 and partners with someone that's market unfriendly. Well, once that is passed, then the foreigners might start to buy in, because foreigners don't really care about, well, investors in general, so not just foreigners, but investors in general are less concerned about the actual outcome as opposed to the uncertainty about the outcome. Once there's certainty, they can price it in and work out whether they want to buy or sell. Uncertainty, they can't. So just getting past that election point could see a recovery in South Africa. So we right now are still underweight South African equity and neutral South African bonds, that we could be changing that if we see weakness ahead of elections or post-elections. So we'll see what happens. Okay, so finally, to positioning. Should we buy in May and sell in May and go away? Or should we be buying in May? No, I certainly wouldn't be buying in May. We remain overweight global equities. We remain overweight risk. But there is so much data coming in, and the Fed is so data dependent, and so much that data is actually conflicting that it's difficult to know what's going on. Right now, the trend is still that the US is exceptional, and that geopolitical risks are rising, and that inflation is still strong. So that keeps us with a strong dollar bias, and it keeps us with the US bias. IMF does agree with that. IMF's world economic outlook for 2024 and 2025 is sluggish, and they took to growth at only 3.2% for both years, which is very much just above trend, just hardly anything to get excited about. And that's definitely differs to the synchronized manufacturing recovery, synchronized manufacturing recovery that we're seeing across Europe and Japan and emerging markets. And it's definitely differs to what we see in commodity prices. And copper is at its highest level since June 2022. Zinc is at its highest level in a year. And you can see on the chart on the right, global manufacturing picking up nicely, above 50. It's on the left axis. And the S&P commodity index turning positive and also picking up quite nicely. And that's very much linked to China. I mean, China is important for commodity prices. China imports more than half the world's zinc, nickel, steel, copper, and aluminium are imported by China. So it's very important to watch China's growth. Yes, China's property market is slowing, but we've seen this huge recovery in manufacturing. Now that as a sector, just looking month on month, that grew at 45% in November last year. It's now starting to taper off year on year, and it's now down to 30%. So we'll be watching to what extent that does taper further, or whether it's becomes sustainable. And if it's sustainable, then we may need to change our view. But the other thing that's keeping us dollar bullish is the high interest rates in the US. So we've already seen interest rate cuts in Switzerland. They've already cut interest rates because inflation is at 1% in Switzerland. Canada and the ECB are likely to cut interest rates in June, while the US is forecast to only cut twice this year now, starting in September and second one in December. So that interest rate differential is means that this dollar is likely to stay strong. Rising geopolitical risks are also going to keep the dollar safe haven bid strong. So with the divergence in interest rate cuts, with the geopolitical risks rising, with the US consumer still looking relatively resilient, we stay overweight the dollar, we stay overweight the US. But it's definitely, there are some big probabilities that in May we could sell and go away. We could downweight global equities and put them to bonds if we start to see the US cooling further and that feeding through to US inflation, Or if we see stronger recovery of growth in the rest of the world looking more sustainable, we'll stay avoid equities and move that into Japan and Europe. So some big decisions that could happen in May, but right now we are not selling in May and going away. Unfortunately, can't go to the beach. We are staying invested and very focused on the very, very data-dependent markets. So that's it from the positioning slide. I'm going to hand over to Phumi, who will take us through manager research updates, and then I'll get back to the polls.
Thank you very much, Carl, for that, and thank you very much for having me in your webinar. As Carl kind of concluded and spoke to the changes that we see and the tensions that we see on a geopolitical front, we kind of bring it back to South African domestic market as well as to the South African landscape, where more than anything, we try to share with you this period or this quarter, what our views have been about our synchronized thinking is from a manager selection perspective. As you can see on this next slide, you'll note that there's been a bit of an industry update from a merger and acquisition perspective, as well as people moves. I think it's intricately quite important to talk to this aspect, especially in the world where we try to synchronize our thinking. And we synchronize our thinking by sharing with you our views where in a manager selection framework, more than anything, there's always two parts to this process, where there's a qualitative aspect as well as a quantitative aspect. And we put together both of these attributes to actually form what our manager selection framework is. But most importantly, for you sitting at home or in your offices, more than anything, from a people moves perspective, when we talk to this part, it's that intangible part in the manager selection framework that is not quantifiable, that is not tangible. However, intricately important because these people moves attribute to the people who look after your investment portfolios, who are actually portfolio managers. Over and above that, some of these professionals that are also included in here are professionals who actually you may have bought the solution from more than anything. So we take all of this and we put it into our selection framework to actually kind of get a sense of what has been happening. For this period, we're just going to be focusing on the first quarter of 2024. And from a merger and acquisition perspective, not surprising that in the domestic SA landscape that there have been 3 mergers and acquisitions for the first quarter of the year. It talks to some of the principles or tenets we had seen in the PwC Global Investment Report, where there has been a trend in terms of consolidations. But if we just look at the firms that have consolidated for the first quarter of the period, we note that there has been a merger between North Star Asset Management as well as First Avenue Capital. Not surprised to see this because there's a deep synergy in terms of their philosophy and the way that they think. North Star, as you will know, was previously founded by Alexander Otten, and seeing those 2 firms come together to eke out value from a capability perspective has been interesting from a market perspective. Over and above that, we also saw the merger and acquisition happen between Methodical Asset Management as well as Numerical Asset Management. Again, deep synergies that align in terms of how both firms think. Methodical, quite pristine, quite immaculate in terms of how they view the world, in terms of how they have these exceptional derivative structures that they generally tend to run, professionally run by Sabront. And Numerical Asset Management, quite sad to actually see that firm close down, especially because they were pioneering and quite first in the generative AI space. Unfortunately, that hasn't boded well for their performance, and seeing Methodical take over that firm does create scope to see what further synergies can be explored, given that derivative acumen that obviously has a quantitative underpin, and that generative AI perspective, which we do know, relies on algorithms as well as mathematics, so deep synergies there. To close off, and especially on a merger and acquisition perspective, it's interesting to see that there has been a major approval that has happened from an FSCA perspective, and this is between Anchor Group, founded by Peter Armitage, as well as coming together with Creditwealth, and that pushes the collective assets under management to north of 230 billion. So that sums it up from a merger and acquisition perspective. This is important to us because when we do look at managers, or when we do scope out from a manager perspective, we're trying to see which managers are growing either organically or through a merger and acquisition perspective. The bottom half of the chart quite busy, as you can see, but this just talks to people moves. Again, at the beginning of the presentation, I attributed to the fact that we do have a qualitative framework, and then in that qualitative framework, we look at various P's, and you'll see in the next few slides, some of the P's that we look at, are people moves, or those investment professionals that are custodians to the portfolios that you are invested in, or distribution professionals. From an asset management perspective, where there have been changes, you'll note that there are firms that we are invested in. 91, has appointed a client director in Lumka, who was previously at Harith Capital Partners. 91, again, similarly, also acquiring a really pristine investment professional from Ashburton Investments, and a manager that we've got exposure to in our fixed income team. Chris Serum, who was previously the head of liability-driven investments within Ashburton, now joins 91 Stable as one of the investment risk managers. From a Visio Capital perspective, quite a niche boutique asset management firm where we've got exposure from our equity solution perspective, affirming to see that what they are doing from a demographic perspective in the appointment of Corinne Cordea, who was previously at Prescient Securities. From a PSG asset management side, big congratulations goes out to John Gilchrist, who has been promoted to Chief Investment Officer there. A firm, again, we don't necessarily hold, but a firm that we do engage with from time to time. As well as, the move that we saw from Terebrinth Capital Partners, where Richard Bray has joined ABAX Investment. And similarly, while on the same side, from a distribution perspective, we note, another change from M&G Investment, where Jason Sears actually left M&G Investments to join Fairtree Investment as the head of retail distribution. From a Sasfin perspective, quite bullish in terms of them appointing 2 key investment professionals there in Bega and Jabulo. And then from a PPS investments distribution side, more than anything, there have been a lot of changes that PPS quite positive, which have attributed quite well to their firm. We saw the appointment of Maxwell Mojapule, previously also from Sanlam Investments, Rashil Jaka, who was at M&G Investments, and Harris Golds, previously also at Discovery Invest. From a regulatory industry body perspective, more than anything, we do note that there definitely is an acting CEO in Adrian Burke. He takes over from Busisa Gia, who actually served as the CEO of Busisa for the last 2 years. And I think last one, more than anything, we saw the immediate departure of Chris Sickle as the CEO of M&G Investments. This also kind of, a big change for us in terms of how we view the world, in terms of how our own solutions are managed, because this last departure has a ripple effect in terms of the next few slides that you will see come through from me, where we have had to make significant changes in terms of how we view M&G Investments as a house, and I'll talk you through those changes. I briefly spoke to you and I said to you, more than anything, there is a 5P process. And from a 5P process, what do we mean when we talk about this? Especially because I started off by saying, the manager selection framework is a combination of both quantitative attributes, and with those quantitative attributes, they're generally quite measurable. Measurable in the sense that we are able to look at a manager's performance through time, whether we look at the monthly investment returns, whether we look at the calendar investment returns of a manager, we can actually look at that tangible data through a certain lens, looking at specific descriptive statistics or metrics, and measure what the manager actually has done or has been able to deliver relative to peers or relative to a respective benchmark. So we can actually tangibly see this investment performance from a quantitative perspective. However, our manager selection framework is not just standard from a quantitative perspective. We also look at the qualitative attributes of a manager. And when we talk to the qualitative attributes of a manager, it's these 5 Ps that are generally softer issues, so we take these softer issues and we intricately marry them to that quantitative process, because this qualitative bucket, more than anything, is heavily subjective. So to sanitize our subjectivity in terms of how we think, we marry it with this quantitative bucket to formulate a view on a manager before we can even decide to do anything from that manager selection perspective. To take one step back, I think there's a big market data that generally talks to manager selection being part art, part science. And the art part is that subjective part that you actually can see in front of you. And the science part is that tangible quantitative bucket. So for the purposes of today's webinar, we're going to focus on this subjective odd bucket. And as you can see deliberately, my pie chart is not even. So those little pieces that have no arrows flowing through them are generally there to kind of show you the subjectivity as well as the rigor that does happen from a 5P process. To start off, just a brief qualitative assessment of M&G, brief being the operative word, because we tend to go intricately quite deep into the level of analysis, qualitative analysis of a manager. We pride ourselves in understanding how the manager thinks, how the manager views the world, and how they actually execute from a risk management and portfolio management perspective. To focus on M&G Investments more than anything, we have a deep conviction in terms of who they are from a parent perspective, and that's the first P. When we talk to parent, we talk to the sustainability, profitability, as well as a softer perception around the firm. And we also look at key metrics that are tangible here when we look at parent, where we look at the assets under management of the firm. And as you can see, from a parent perspective, M&G Investments quite global in who they are collectively, including the global assets, sitting at 7 trillion assets under management. And if we bring it back down to South African shore to synchronize our thinking, they do sit at 316 billion assets under management. You pause and you hold that thought there. Why is this P quite important? This P is quite important when we do our manager selection framework, simply because when we do invest in any manager, we don't want portfolio concentration. We don't want asset under management concentration, where we are one of the biggest investors within the manager. So we hold that thought. While we look at M&G, and you recall from the previous slide, the immediate departure of that CEO then sends signals to this manager research tool that we have innately, which is a proprietary tool, and it starts to send off alarm bells more than anything. So even though we may have a deep sense of conviction in terms of an assets under management perspective, if we move over to the second P, which is people, and again, that P is broken down quite variously or quite deeply. We look at the designation of investment professionals, the qualifications of investment professionals. We look at the demographic of the investment team, and to a certain extent, we push this to a point where we actually look at the male to female gender ratio as well, quite important in terms of how we assess a manager from a qualitative perspective. Specifically focusing on M&G, there have been significant changes from a people perspective across the various spectrums of the business, across the various capabilities within the business, but innately honing it in from a people perspective, where there have been significant changes within the C-suite. And what do I mean when I talk to the C-suite? I'm talking about that office where we've got the chief investment officer as well as the chief executive officer. Just to catch my breath, from that perspective, we had a deep conversational, communication with the chief investment officer, previously known as David Nee, who has actually came forward and said to us he's going to go back to the UK to relocate, and is going to be still immersed within the M&G investment business. However, his relocation into that UK business takes him away from the South African business. That again is something that sends an alarm bell or a signal to our qualitative manager ranking tool. The immediate departure of the CEO, Chris Sickle, is again something that also sent through lights. And I think if I had to use an analogy from a robot perspective, the first light went amber when we saw the departure of the relocation of the chief investment officer. The lights then instantly went red when we heard about the immediate departure of the chief executive officer. Why did the light immediately go red for us? The light went immediately red for us because in the communication with the change from David Nee relocating to the UK, what we were told as investors through a qualitative lens as well as a manager research team was that David Nee is moving over to the UK, and the heads of the various capabilities or the investment professionals that look after equities, multi-asset, as well as fixed income will then report directly into the chief executive officer. This change or this immediate departure of the CEO then created alarm bells, because it then meant that those heads of capabilities no longer report into the chief executive officer, and that created a structural shift within the investment team, which sends further alarm bells into our qualitative tool. And that change in the investment structure started to make us feel a little bit uncomfortable. From a philosophy perspective, we are innately comfortable in terms of how the manager thinks. Their valuation-based framework is quite important. Again, within the manager research fraternity, we call this kind of manager quite steady Eddie because, they deliver what they deliver relative to benchmark, the way they think, the way they view the world from a valuation perspective, a risk management perspective, and always intricately knowing that they've got the long-term horizon in how they view the world is something that we kind of still value. So that's still a positive from that perspective. And if you move over to the fourth P, which is the investment process, and this is the part where they actually execute, where that people component, where that people bucket comes into play. You'll recall I'd said David Nee was previously the chief investment officer. So now there's no longer a custodian to this, but there's various heads of capabilities to the structural shift to the investment team. But when they look at the process, what are the key things that they focus on? They focus on the bottom-up fundamental analysis, trying to innately understand what the balance sheet is telling them from the various counters that they actually invest in. But more than anything, when they do finally construct a portfolio, they have a risk-conscious mindset that actually helps them assimilate their thought as they've looked at that bottom-up fundamental bucket. Having said all of this, we then start to reassess our positioning within a manager, and you'll see within the next few slides what I mean when I say reassess our manager. And if we bring it back to performance, considering that we had only been invested with this manager for quite a short period of time, with all these alarm bells signaling on our qualitative tool, we couldn't negate, we couldn't take further risk by continuing to hold our investment within M&G Investment, which then created a resultant change where we had a complete disinvestment from our equity solution. If we look at the performance, which is the last P that we kind of look at, and not last because we don't pay attention or focus on investment performance, we innately focus on investment performance as had previously iterated, but there had been relative underperformance relative to cap Swix, which then also had some impact in terms of the decision that we had taken. Just to almost kind of, before I close off and conclude, quite a short update that does come from the manager research side. And, before I hand over to Carl to kind of take you through those poll results again, our decision to disinvest from M&G Investments was not something that we thumbsuck. It's not something that we did overnight. It was a series or a set of continuous, unfortunate developments that forced us to actually reverse our decision. And again, as a manager research team, we're blessed enough to have, the principals or the custodians of a broader investment team, where even myself as the head of manager research, we almost held to account in terms of, is this manager still performing the way that they're supposed to? Do the modes and the softer metric that actually allowed us to make this investment into this manager, do they still hold the fort? And when they no longer hold the fort, because we've got this qualitative bucket that we actually look through and we assimilate our thoughts and we marry it with the quantitative, we then decided to be pragmatic because, again, there are a number of gray hairs in our team who have seen similar events in the market. We then decided that the best thing to do is to reverse our investment decision for the benefit of our investors, to be prudent, to show due care and skill in terms of how we view managers. And again, when we had included them in the portfolio more than anything, we'd included them because of the stability, a steady eddy, the improvement in the risk return metrics that we did see come through from the manager. Yes, that held together from a process perspective, and yes, that held together from a risk and return metric perspective. However, the continuous movement from an investment team perspective, the changes in the structural team, kind of then forced us to reverse our decision. And again, as I said to you at the time, we knew David Nee was going to depart as CIO, made us quite uncomfortable, and this was in January 2024. And again, with David departing, we then saw this structural team shift where there is now multiple chief investment officers per capability. Just to hold the thought on the multiple chief investment officer, these investment professionals who remain custodians or who are now heads of the various capabilities within M&G still rank quite highly, quite astute, quite high pedigree, quite seasoned in our ranking tool. But we can't negate the fact that there's been a structural shift, as this is not the way in which M&G Investments used to run the investment team. So what we then decided to do is to disinvest, and in disinvesting is to rather have a wait and see approach for the next 12 months. And over and above that, the significant departure and the immediate departure of Chris Sickle came as quite a surprise to us. So on behalf of our investors, we then decided the most prudent thing to do is to disinvest our assets from the manager while we actually monitor what's going to happen over the next 12-month period. I'm going to hand over to Kyle. Thank you once again, Kyle, for having me within your webinar for this month, and we will talk again in the next quarter.
Thank you, Phumi. Okay. Let's have a look at the polls before I get to Q&A. What percentage of votes will the ANC win? Sure. Very, very evenly distributed between 40% and 48%. So if you'd have to take the median of those 2 points, you're looking at 44, which is close to Simon Fremantle's 45. I think it's probably a realistic number. So we'll see where that comes in. At least if we get 44, 45%, it should be a good outcome, depending on who they partner with. Oh, except if I move to question 2, there's definitely a concern or belief that the ANC will then partner with EFF and or the MK. That definitely would not be a good outcome for the markets. Markets are very, very concerned. Well, foreigners are very concerned about that coalition and what the kind of policies that we put in place. So that is, yeah, a concern. Definitely based on that analysis, I would stay underweight South African equities and neutral SA bonds, which we are. We'll see how that goes. China. 2/3 of you believe that China is investable in the short and the long term. That is very interesting. Very, very interesting. I mean, there's a lot of concerns that with Xi Jinping taking on a 3rd term, that he's entrenched his dictatorship, that he's not market friendly, and as a result, market returns or capitalism will not flourish over the long term. So even those who are bullish in the short term would be negative in the long term. But yeah, very, very interesting to see that 197 of 299 of you believe that China is investable in the short and long term. Well, certainly the MS Sygnia new sectors, Sygnia Itrix new sector, China new sector ETF, what a mouthful, has had quite a nice rebound and continues to rebound. So for those of you who believe in it, you definitely have the right vehicle to access that view. And we may add that back to our funds if we see a sustained rebound there. What is the probability that geopolitical risks will push oil up to above $100 a barrel? Between 30 and 50 seems to be the major answer. Yeah, I think it's closer to 30, not above 30, but it's definitely a risk. We're sitting at $83 a barrel, and I think there should be probably a $10 risk premium priced in, maybe $93 to $95 a barrel. I don't think we'll get over 100 by year end, but it certainly could happen. And then finally, a number of rate cuts. 1 is the preferred answer in this survey. As I said, markets got to the worst case. The market has priced in to only 1 cut. That was about 2 weeks ago. Since then, the market's now pricing in 2 cuts. So very interesting that the higher for longer scenario is the base case for the people who are on this poll. Certainly, our higher for longer is our base case as well, and we're definitely positioning for that. We may change that view, but for now, a higher for longer is appropriate. So yeah, generally the views of people on this poll are in line with our views. Underweight South African equities, higher for longer, less than 50% probability of geopolitical risk impacting markets. The one thing that is different from our positioning is China, and that 2/3 of you believe that China is investable for the short and long term. So it's very interesting. Thank you for that feedback. Okay, Q&A. Mervyn says the Sygnia Fourth Industrial Revolution ETF tracks Kensho New Economy Index. Why is there a mismatch between the South African pricing and the US pricing? Mervyn, it would only be, I mean, the tracks the index 100%. Any differences are currency. So the US Kensho product is dollar-based, ours is rand-based. So any changes in the currency will lead to that. Also, there's not much time when both are open at the same time. Right now, daylight savings, the US opens at 3:30 our time. Our market closes at 5. So there's only 1.5 hours that both are priced at the same time. But during that 1.5 hour period, excluding rand movements, those should move exactly in tandem. And that's what the market maker's job is there for. The market maker is there. We use Jane Street. They're there to take any arbitrage opportunities and use that to ensure that those remain in line. So they are in line. Leon asks, is the Sygnia Life Berkshire portfolio available on the 91 platform? No, it's not. So all our life products are not available on any other platforms because our platform uses the Life Wrapper to access it. So you can't access Sygnia Income Maximizer or the Sygnia Life Berkshire Hathaway Fund on other platforms. You need to be on the Sygnia platform to access those funds. Aubrey says, US exceptionalism, I wonder how much of that is actually stimulating when one considers that the US does not have the money. They have to create additional debt instruments in a high interest rate environment. Aubrey, you're right. So it's not only about taking on debt. I mean, during COVID and after the great financial crisis, we had QE, which is basically taking on debt and printing money, but it didn't stimulate the economy. What needs to happen is that banks need to circulate that money. You need the velocity of money to pick up, and that's what we're seeing now with the fiscal stimulus. So monetary stimulus takes a bit of time, but fiscal stimulus, particularly when that money is printing money, literally putting a check in each consumer's bank account, then it does work. So the recent fiscal stimulus has definitely been stimulating, whereas the previous monetary stimulus wasn't as stimulating. Yes, I hear you. We are in a high interest rate environment, so there are certainly conflicting issues. I think what the Fed is realizing, and I think they're a little bit annoyed by, is that in South Africa, for example, if you borrow money to buy a house, you can get fixed rates, but they're very expensive. So most of us link our mortgages to short-term rates. So as our SARB and our Monetary Policy Committee pushes up rates, so we feel it immediately, then we reduce our consumption. The majority of corporate debt and consumer debt in the US is linked to long-term rates, 30-year rates. So there's not the same direct feed through from the high. So the high interest environment is taking longer to feed through into the US. I think that's also what we're seeing happening there. Very good question. Thank you. Anish says, what will happen to the price per barrel of Brent crude if there are disruptions? And Anish, certainly, I think we could at least see a $10 rise in oil prices for any small disruptions, but it would have to have something significant to push it over $100 a barrel. Mike, Sygnia online platform is still work in progress. Unfortunately, I can't tell you anything more than that. Hopefully, we'll have some definitive answers and timelines for you soon. I'm sorry about that delay. Wayne says, is the US inflation and employment dilemma not artificial, given that there's up to an 18-month lag under normal circumstances? Wayne, you're spot on. That's why Powell is saying there's no stag, there is no inflation, because when employment cools, people stop chasing jobs, which we're seeing already with the hires and quits rates. It means they're not chasing up their wages, which means wage inflation falls, which means that inflation falls, and there is a lag. All you have to worry about is inflation expectations, and we have seen inflation expectations on the one-year basis rise. So it's about the Fed's trying to talk down those inflation expectations, and he should be able to talk them down because we're saying there is a lag. But the concern is that inflation expectations stay high because people don't understand the lag, and as a result, they start demanding higher wages, even though employment is weakening, and that's your stagflation scenario. So Paul's doing his best to convince the market that we're not in stagflation, and he is right to do so. He's just got to explain that to the consumers and corporates so that they make sure inflation expectations come down. Diane, yes, a recording of this session will be made available on our YouTube site. So if you want to see anything that happened, any access to any slides or anything that I said, it will be posted to our YouTube site. All our webinars are on our YouTube site, so you can get any of the backdated ones there. Thank you, Clive. That was sorted. Thank you, Enrico. That was sorted. Johan, I have answered. Johan, that as well. We're definitely very, very keen to set up a dollar offshore offering for our clients through our platform. We are waiting on our new platform so that we can do multi-currency or do dollar investments, and that would allow you to switch seamlessly, convert rands into dollars and invest in any offshore dollar-based funds. Right now, we don't have any. We closed down our dollar-based funds. We are waiting for that platform to be up and running, and then we will make that available. So hopefully we'll have some updates for you shortly on our platform. Anish, no feedback on the Fourth Industrial Revolution Fund. It is, as we've said before, it tracks the Kensho index, which is very much a small cap index. It's tracking the Russell 2000 index, which is US small caps. And because of the higher for longer scenario, that has been struggling. We did see a small uptick in the last few days, just when employment was so weak. But the jury's still out about higher for longer, and our base case is still higher for longer. So I think it's a little bit too soon to be buying US small caps. Maybe start nibbling if you want to diversify, but I think we still need to wait a little bit longer. Anonymous says, what is the future growth of the FANG.ai ETF? Well, Anonymous, that sorry, please in future, just give me your name so I can link questions to different people. But the FANG.ai ETF, it's got some considerable earnings growth coming through. And if you look at the recent results, you've just seen we had very nice results from Apple. We had, despite Berkshire Hathaway selling a bit, we had very nice results from Google. We had very nice results from Amazon. The big five, the only one that disappointed was Meta. Meta said that they're going to be spending more than expected on AI in terms of research and development. The market didn't like that. But overall, those big stocks doing well. I do think that is a risk structurally to the stocks, at least in the short term, where AI is very much in a strong R&D phase. So a lot of money is being spent. We still yet to see exactly how that's going to pan out. I'm very bullish on AI in the medium to long term, but in the short term, we could see some cash flow reductions as that R&D is increased. And again, we've got those five companies all competing to try and do the same thing. So it'll be interesting to see who's the winner. But as I said, earnings right now, advertising revenues are up, cash flows up, dividends are being paid for the first time. Those companies are really looking strong in terms of their fundamental business models. So more the FANG than the AI. And so we're seeing some strong growth there, and definitely no cause for concern when it comes to the recent spate of results from the FANG stocks. So that is looking strong. The biggest risk, again, in the short term is probably the breaking up of the monopolies, the antitrust legislation. But again, we're in an election year, and no one wants to be too anti anything that might disrupt the economy. So I think while there might be saber rattling around that and noise, it's unlikely that anything is going to be passed anytime soon. Okay, another question. Will the Sygnia AI fund be open for direct investments again? The FANG.ai unit trust is open to everybody but direct investments. So RAs, LAs, endowments can all access the unit trust. The ETF is open to everybody, and so direct investors can invest in the ETF. The underlying investment strategy is identical. identical. So yes, the ETF was only launched 6 months ago, but if you look at the performance, they track each other. If you look at the positioning, they're identical. The FANG ETF and the FANG unit trust are identical. So there's no opportunity cost from being in one or the other one. So please, if you can't access the unit trust, access the FANG ETF. In fact, FANG ETF, we put it up an announcement recently where we are removing the performance fee. There's no longer a performance fee on the FANG ETF, which means that tax-free savings accounts can now access that. Well, I think there might be a 3-month waiting period or something, but the FANG tax-free savings accounts can now also access that ETF. So everyone can access the FANG.ai ETF. No performance fees, which is fantastic. So that is your access point if you can't get into the unit trust. Carol says, I missed a few minutes. You still favor to be heavy weighted in US equities? Carol, yes, we are still overweight the US. I think strategically, with the US making up 70% of MSCI World and S&P 1200 Global, with the dollar being the base currency for trade and EM debt, with the rest of the world interest rates dependent on US interest rates, your starting point with any investment strategy is the US. Then you can tactically invest in other regions as you see fit. And other reasons for that are the US is just the cleanest shirt in the laundry basket when it comes to everything else. It is the global safe haven. They do have the highest amount of spending on R&D. They do have the strongest consumers. They do have very strong educational systems. They've got probably the most capital-friendly legislation in the world. That's very important. So when it comes to being money-friendly, the US is definitely there. And then you can look at investing elsewhere at different times. But that is our starting point. And the index is definitely overweight the US. So it's the index starting points as well. But we don't want to be overweight the US if it starts to slow significantly, which could be the case with employment slowing. And we also don't want to be overweight the US if the rest of the world growth becomes more entrenched. Japan, Europe, emerging markets, China. So we are watching that position quite closely to see what to do. Sean says, will Sygnia release a mobile app? Yes, we are working on a mobile app. I can't tell you how long it's going to take because that is development, but we are definitely looking at releasing a very exciting mobile app. Thank you, pleasure. And that's it for Q&A. Oh, sorry, one last question. Are crypto ETFs a good investment at the moment? Question to end off, I suppose, at least you didn't ask me what the currency forecast was. Bitcoin is, or crypto ETFs are very difficult to forecast. As you know, we subscribe to global Alpine Macro, global macro strategists, and we subscribe to BCA. BCA have 2 views on Bitcoin. Their one team's view is it'll fall to $5,000 per Bitcoin. Other team's view is it'll go past $100,000. So it's pretty much nearly in the middle of those 2 right now. I think that there's a lot of volatility, too much volatility to make it used as a safe haven currency. I think there's a lot more interest in stable coins. So to the extent you call crypto stable coins, even though those stable coins are linked to the dollar, they are decentralized. So if you're trying to get your blockchain decentralized benefits, but you still have the safety of or stability of the dollar pricing, and then stable coins could be something that are interesting. But then why not just invest in the dollar? I mean, you're going to get the same thing from a price movement perspective. So that is I suppose the counter argument to that. There's been a lot of noise recently about BRICS bringing out their own currency. I still don't think that's going to happen. I think BRICS are working very hard to move commodity transactions into their own currency, so bilateral agreements. So if it's China buying oil, it'll be in the Chinese currency and not the dollar. But getting a BRICS block currency, I think, is highly unlikely. There's just the euro barely holds itself together, and those countries are much physically closer, and they've got much closer cultural ties, and they've got a better monetary union. So I don't think that's going to happen anytime soon. And finally, sorry, these questions are trickling in. So last question from Robert says, what is Sygnier's stance on the two-part system? Robert, we don't have a stance. We are just reacting like everybody else. Everyone's doing, it's a mad rush to try and get our systems updated to meet the September deadline. We will ensure that we have met the September deadline. There's still a few questions on exactly what that means from a tax perspective. We may see some from our perspective, from an investment perspective, we may see an increase in outflows if people cash in that once-off outflow. And it's estimated that South Africa-wide, it could be in the billions of rands. We don't think it'll impact our portfolios significantly. We do have sufficient liquidity in our funds to meet that outflow, so we're not concerned about that from an investment perspective. So we'll wait and see how it happens, and if there is any clarity from a regulatory perspective that arrives after the event, at least from a Reg 28 perspective, or an investment regulation perspective, or a tax perspective. We are watching that quite closely, but we don't have a stance so much as we will make sure that we get it done, and if people want to withdraw their money, they will be able to. So that is where we are on that. Perfect. That is all the Q&A. Once again, thank you so much for joining. We really appreciate your time. I really appreciate you joining and your questions. Phumi, thank you so much for sharing your insights today on the industry and our views in terms of our managers. It was great to have you. And everyone have a great month of May. I hope markets don't sell off and are strong. And I will see you in June for the next market update. Take care.